Monday, January 8th, 2024, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at how well the economy in the U.S. is really doing, and especially with the data that we saw on Friday about the U.S. Job situation. I think it's not as great as it looks. It's not as great as the headlines profess it to be. And we're also going to touch upon the banks again. I spoke about the banks recently, how they could be in deep trouble. But today we're going to focus on the big banks because it looks like it's going to be a very important week for the big banks. Before I do, though, I'd just like to let you know that I still have a promo code with the Dirty Man Safe. And many of you, of course, who are not just stackers of gold and silver, but have valuable possessions, have asked me in the past, how to keep things safe. And I think the Dirty Man Safe is one of the ways, not the only way, to try and keep your valuables safe in these uncertain times, not just economic and financial times, but also socially, politically, and also because of the fact that law and order seems to be breaking down in a lot of countries in the West. We're seeing illegal immigrants come into all the major Western countries, and our governments do nothing about it except to fund them when they get here. We're hearing about police here in the UK not really caring about things like shoplifting or burglary. So I think it's more important than ever. So check out below in the description the Dirty Man Safe. It's also sold here in the UK now. And the promo code that you need to use is Monaco10. You get 10% off. So back to the banks and the U.S. economy. And of course, the U.S. economy is still very important for the whole Western economy, also for the whole world economy, alongside the Chinese economy, I would say. And despite the fact that we had a 4% GDP growth, I think, for the third quarter, I think things are a lot worse than the data show. It's becoming a little bit like the old Soviet Union, where they used to issue statistics for the economy that were completely contrary to how well the economy there was doing. And it came as a shock, of course, in the early 90s, late 80s, when the Soviet Union collapsed. But I think a lot of people back in the day who knew what was really going on were probably not too surprised with the collapse of the Soviet Union. And I would say we're very close to the collapse of the West, in my opinion. Things are not the same as they used to be. And first of all, I'd like to bring up an article from Fox Business. And they've noticed it as well. And it says, initial U.S. employment reports overstated by 439,000 jobs in 2023. So what does that mean? Well, that means that the Bureau of Labor Statistics, under probably the guidance of the administration and the Treasury, what they've been doing is they've been erring on the high side. They've been publishing data that are too high, and they've been revising it thereafter. And why would they do that? Well, I think it's to try to keep the financial markets from imploding. It also says here 8.7 million Americans, a record high, hold multiple jobs to make ends meet. That, in my opinion, is not a sign of a healthy economy. And why? Why do I think the economy isn't healthy? Well, because ever since the '08 crisis, the powers that be, the Fed, the Treasury, they've been inflating the system to keep Wall Street going. Yes, we're paying for Wall Street so they can keep gambling, speculating on the back of the taxpayer. And the same thing has happened here. And that's why we're racking up such huge debt, national debt, personal debt. The personal debt, of course, comes as the result of the currency becoming more worthless as the days go by. So people have to resort to borrowing more. And it's all got to do with saving the banks in '08 and saving the banks and hedge funds again in 2020 because of the repo crisis. So let's quickly go through this article, and then we're going to look at the banks, and especially the big banks, because there's some important news this week concerning them. There's something wrong with previous U.S. jobs reports. So they're noticing it now. Fox Business. The government quietly erased 439,000 jobs through November 2023. A closer look at the numbers from the Bureau of Labor Statistics, or the Bureau of Lies, I would say. That means its initial job results were inflated by 439,000 positions, and the job market is not healthy as the government suggests. Oh, what a surprise. Since the government wiped out 439,000 jobs after the fact, the total percentage of jobs created by the government last year is even higher. So yeah, it's all due to deficit spending. And, governments don't create wealth. They don't create real jobs, do they? Increased government hiring has been driving the jobs numbers higher. And I've been saying that. I've been talking about the fact that we're running deficits that are akin to a period of a recession when Keynesians pump up government spending. It's all artificial. And that's why I think the economy is in trouble, despite the fact that Janet Yellen said on Friday that we've achieved a soft landing. As Clive Thompson said yesterday on the live stream, she's just trying to sell treasuries for as much as possible. And by that, I mean she wants to pay the least interest on the debt that she's selling. This matters because U.S. jobs reports move the market. There you go. That's why they're manipulating the markets. And U.S. Treasury yields. Plus, they are a significant factor in the Federal Reserve's decisions about the path of interest rate hikes and cuts. All that affects U.S. consumers' pocketbooks. So, aren't the guys at the Fed clever enough to realize that it's all a bunch of lies? Well, I think they do, but they're playing along with the Treasury and the government. Time to stop trading off the payroll data, tweeted David Rosenberg, founder of Rosenberg Research Associates. By his calculations, he says the downward revisions came to an epic 443,000, adding more than 40% of payroll growth in 2023. Came from the fairy tale birth-death model the BLS uses to guesstimate its jobs reports. Again, the government sector in December ranked high in job creation. It created 52,000 jobs in the final month of 2023. As Fox Business Edward Lawrence points out, that brings the 3-month average jobs created by the government sector to 50,000 per month. Lawrence says Acting Labor Secretary Julie Su would not answer if this is sustainable when I pressed her. Well, she didn't answer probably because it isn't sustainable. It's just fudging the numbers. Yeah, I'm going to stop right here. The other thing that I noticed is that I'll come down here towards the end, and I think this is significant as well. As Edward Lawrence reports, the December jobs report showed 683,000 workers dropped out of the labor force. A record high 8.69 million people now hold multiple jobs to make ends meet. And this is the big one here. The economy lost 1.5 million full-time workers since June last year, while adding 796,000 part-time workers. So why is this important and related to the banks? Well, because if the jobs sector is not as good as people thought, that means debts are not being paid. And analysts, economists, investors, they've gotten the wrong data. They've gotten the wrong indicators from the government, and they've made decisions to invest or whatever based on numbers that weren't true. So that's why it's so important, I think, this week when the big banks start releasing their earnings for the fourth quarter of 2023. And the FT has caught on to this, and it's on their front page, online front page. It says, largest U.S. banks set to log sharp rise in bad loans. Earnings are expected to have shrunk in last quarter of 2023 due to unpaid debts and impact of higher interest rates. So my hunch is that these results for the big banks, which are JP Morgan, Citi, Bank of America, Goldman Sachs, Wells Fargo, and Morgan Stanley, are going to be even worse. And of course, it's probably even worse for the regional banks and the smaller banks throughout the U.S. economy. So, and I think that's what triggers recessions and market turmoil. The unpaid debts, the bad debts, which start to permeate through the economy as the economy slows down. And I think the only way they can keep this economy going is through more deficit spending. I know they came out with some kind of spending agreement yesterday in Congress, and they're like saying, "Oh, we're going to save $20 billion." I mean, $20 billion is a drop in the ocean. If they said they're going to save maybe, $2 trillion over 2 years, then yes, that would be interesting. But all that Congress knows how to do, be it blue or red, is to spend. And that's why we're up to our necks in national debt, not just in the US, but here in the UK as well. That's the only thing they know how to do here too, the politicians. And it seems to be everywhere, really. So, yeah, I'm not going to go through the whole article here, but suffice it to say, these earning results are coming out this week. You've got Bank of America, Citi, JP Morgan, and Wells Fargo. They will be the first of the large banks to disclose their results. And that will be on Friday, January 12th. And then next week, you're going to get Goldman Sachs and Morgan Stanley. And I think it could rock the markets, the whole markets, these results. And it could show that the economy really is not as good as it looks. And again, I think Janet Yellen is going to be proven wrong. She was the one who said that during QT back in, I think it was, let's have a look here, because it's been a while since that happened. But yeah, back in, I think 2018, just before they started doing QT, she said it was going to be, or 2017, I think, because she was still the chairman of the Federal Reserve. She said it was going to be like watching paint dry. And then, yes, they started doing the QT beginning of 2018. They got the balance sheet down from 4.4 trillion to around 3.8 by September 2019. And we all know what happened from September 2019 onward. We had a massive repo crisis, a massive banking crisis on Wall Street, which was really covered up by another crisis that you remember well in the beginning of 2020. And then the balance sheet went on to rise to almost 9 trillion in less than 2.5 years. So what do we do in this instance? Well, it's difficult. I'm not professing to have the solution to everything, but I think that the important thing is to at least know what's really going on underneath the surface and not be dependent on just headlines. Like, on Friday, I'm sure there were a lot of headlines saying the economy is doing really well because, you had the non-farm payroll data was a lot better than expected. But what the headlines didn't say was what I've been telling you this morning, or whatever time it is when you're listening to this report. So with that, let's quickly look at where the markets are this morning. It's just past 8:30 a.m. London time. Of course, I am in London. For those of you who don't know, that's why I give you the time where I am. So we've got spot gold at 2030. Yes, we're down $15. The high's been 2046 and the low 2027. We've got spot silver trading around 23, is down about 20 cents. The high's been 22 and the low 22.91. We've got the Dow futures down 100 points, NASDAQ 100 future down 8, and the S&P is really unchanged, just below 4,700. To the currencies, sterling is down about an eighth, just above 127. The euro is virtually unchanged at 109.35. The dollar is down slightly versus the yen at 144.43. The dollar is just below 85 versus the Swiss franc. It's unchanged. And the dollar is up slightly versus the yuan at 716.90. Aussie dollar is down 0.4% at 66.90. The Canadian dollar, the dollar is up, 0.2 versus the Canadian dollar, 133.87. And the Kiwi dollar is down a third at 62.22. To the commodities, WTI crude is down 0.7%. It is trading though at 73.25. Brent is down 0.2% at 78.09. We've got platinum, that's down about $9, trading around 955. And high grade copper actually is unchanged at 381. And last but not least, the US 10-year yield is virtually unchanged. It's at 4.05. The 2-year is unchanged as well at 4.40. So with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.